Hey everyone, welcome back to the channel, which is all about how to generate passive income from a diversified portfolio of high yield funds. And speaking of high yield funds, today's video, I'm going to discuss split share funds or split corporations on the Canadian stock market. So split funds, they're very, very high yield. They're very attractive for the high yield that they provide, but a lot of people don't understand how they work. And I'm not going to cover that in this video because I already did a 1 hour long split funds explain video. So if you don't know what split funds are, the first thing you need to do is understand how they work. So make sure to check out that video before you invest in any split fund whatsoever. So in this video, once you understand of course, what split funds are and how they work, preferred shares versus the Class A shares, etc. Today's video, I want to discuss 6 factors I think you should consider before investing in any split share fund Class A shares. I'm talking specifically of the Class A shares, not the preferred shares. Those are safe. Consider those kind of like fixed income safety funds, but I'm only going to be specifically talking about Class A shares here. So split share funds, a lot of them have stopped paying right now, like FFN, Dividend 15.2, DGS, right? And it's making a lot of chatter in the Facebook group. So everyone's talking about them, and whether you hate them or you love them, it's important to know these 6 factors before you invest in any of them. It will help you and you will be thankful that you've considered them before investing. So let's get to it right away. 6 factors to consider before investing in any split share fund Class A shares. So factor number 1, and this not only goes for split funds, it goes for all closed-end funds, everyone. Split funds are technically closed-end funds, don't forget that. So factor number 1 is, what is the NAV price versus the actual stock price or the market price, right? Very, very important. The NAV, which stands for net asset value, is really what the value is of this fund right now. So it takes all the stocks inside of it, does the average, right? And this is what the value of the fund is. Meanwhile, the market price or the stock price is what is it trading for on the open market right now. If you want to buy a certain fund, that's the price you're probably going to be paying, the market price. So you got to compare them and figure out if it's at a discount, if you're getting it at a discount, or you're purchasing it at a premium. So I'll give you a quick example with the Brompton ones here. So SBC, right now, the closing price, and this is as of July 14th, so it's only 1 day behind. I'm filming this video on July 16th on a Saturday, so it is literally 1 business day behind. So the closing market price or the stock price of SBC Class A shares is $11.10, but the NAV, as you can see here, the NAV is $8.84. So the stock price is, or the market price, the price that you have to pay if you want to buy SBC right now, is higher than the actual value of SBC. So you have to pay a premium. You're buying this at a premium, right? So how do you calculate the actual premium percentage? Well, it's very easy. You just take the big number, which is 1110, divided by the small number, which is 884, and then you do -1 times 100. So always big number divided by the small number, -1 times 100, and there you have the percentage, 25.56% premium, which means you have to pay, you are paying, if you're buying SBC now, 25% more than what it's actually worth. So you typically want to try to get and pay the lowest premium possible, or even better yet, get it at a discount. But keep in mind that many closed-end funds, especially high-yielding split funds and closed-end funds, typically do trade at a premium, all right? It's very rare and it's an exceptional circumstance, but they can trade at discounts. It is possible. An example of a discount would be DGS right now, because the value is $464, but you could buy it for $457. So you're getting a tiny discount, right? But of course, DGS is under $15 unit NAV. The unit NAV is Class A shares plus the preferred share value, right? If you don't know what I'm talking about, you got to watch that split fund explain video. But typically when split funds stop paying, that's when you could get some discounts, because people usually panic. They sell them because it's not paying anymore, and there's more of a negative view on them. So that's when they typically go on sale, or they become at a discount. So very important. First things first, everyone, when you're deciding whether to buy a split fund Class A share, got to compare what it's worth to the actual stock price, right? The more the premium is bigger, the less attractive it should be, because you're paying more than what it's actually worth. The closer it is to the NAV, or the smaller the premium, or better yet, if there's a discount, the more attractive it is. You're getting automatically a good deal. Factor number 2 is, what is the fund's unit NAV? So as we know, the unit NAV is the NAV of the Class A share plus the preferred share together. So it's important to know what the unit NAV is and how close is it to $15, because 99% of split funds out there have a rule in place where the unit NAV has to be $15 or higher for the dividend to be actually paid out to the Class A shares, right? So the closer it is to $15, the more, or if it's under $15, if it's under $15, the Class A shares is not getting a dividend. But if it's over $15, it will. But how close is it to 15? Is it 15.50? Is it 16? Or is it 20, 21, 22, 23? The closer it is to 15, the higher the chance that if whatever stocks inside that portfolio go down, or if there's a general market sell-off, the more there's a chance that the unit NAV will go under 15 and the dividend will be stopped. The higher the unit NAV is, if it's past 20 or 21, 22, 23, the higher it is, yes, your yield is lower, but there's a lot slimmer chance that you will miss a dividend. So you got to find out what the unit NAV is, and to figure that out, you have to go on the fund's website all the time. So if you click on any Brompton split fund, you will actually see the unit NAV here. So Brompton has the best website because they actually show you unit NAV. So unit NAV is the NAV of the Class A shares, which is 884, plus the NAV of the preferred shares, which if you click here on the preferred shares, you see the NAV is 1002. So 1002 plus 884 gives you the unit NAV of 1886. So fairly well above 15 here. SBC is one of the more safer split funds because it just has the 6 banks, and it has a, even during the COVID-19 crashes, it has not missed a dividend payment. So the unit NAV is very important. The higher it is, of course, the less yield you're going to get. So LBS is another split fund, for example, that has a unit NAV which is a bit lower than SBC, 1644. So it's a bit closer to 15. So there's more of a risk of missing dividends potentially, but your reward is higher. Your reward is higher because of that, right? It's the yield is 1397 compared to 1071, and you could go on and on, right? So these are the Brompton ones, very easy to see. The Quadravest ones are a bit harder to figure out what the unit NAV is. Not really, but I'll show you. It's because it's not really specified. So if you go on any Quadravest one, so DFN for example, you got to scroll down and look at the valuation. So here you see a NAV pre-distribution, a NAV net of distribution. Always go with this one because this is just taking into account the latest distribution, so it's a bit more accurate. So here it says NAV net of distribution 1633. So it should actually say unit NAV. It doesn't say unit NAV, unfortunately. I begged them to put that on their website. They haven't done it yet. So the unit NAV of DFN is 1633. So unlike Brompton, where you could see what the NAV of the Class A share and the NAV of the preferred share is, you cannot see that information on the Quadravest ones. You only get the unit NAV. But a cool trick, a very easy thing to figure out what the actual NAV of the preferred only share is, it's always about $10, right? So if you want to get the NAV for DFN on just the Class A shares, what you could do is simply 1633 minus 10, right? So the NAV of only DFN Class A shares is approximately $6.33. Unit NAV, $16.33. So very important to look at the unit NAV, everyone, when investing in split share funds. The closer it is to 15, the lower it is, the more risk you're going to have of missing dividends. The higher it is, the lower the yield, but the less chance there is to miss dividends. This is why you cannot put all split funds in the same basket. They're not all the same risk level in terms of missing dividends, right? You have some really, really low risk split funds like SBC, then you have some higher risk split funds like DGS and DFN that can miss. There's more of a chance that they miss. So very important to take that into consideration, factor number 2. Factor number 3 is the dividend miss history, right? So obviously it's important to know, or it's good information to have when you know, especially if a fund has been around for many, many years, over 10 years, how many dividends has it actually missed in the last 10 years? So that's very important because it could give you an idea of the chances of missing dividends or potentially in the future, right? So there's several ways, the only real way you could do this is by going on the fund's website and finding all the distributions. They're typically listed there. So in Brompton, if we take SBC for an example, you click on distributions, and throughout the years, you got to select a year. It's not it's a bit long and time consuming to do, but you could actually see every month if it's paid that 10-cent distribution or not. And you could go throughout the years and go and keep going to actually figure it out until the original dividend, or the first dividend, is paid out. So that's one way of doing it. For QuadraVest, it's the same type of deal. If you go on their website, you click on distributions, for example, on Dividend 15, it's going to give you the whole dividend history, the whole distribution history. It's a bit easier to do in QuadraVest because you literally have them all here, and you could see every single month since the beginning of the fund if it paid out that 10 cents a month. And I know for a fact that DFN missed only 4 dividends, all in 2020, I believe. So if you go to 2020, you can actually see them here. So you see they missed, you see 0 in March, in April, in May, and I think there was one more, yeah, in October. So these are the only 4 dividends that DFN missed, for example. So you have to, it's very important to get that dividend miss history. An easier way, if you want, when you download my entire portfolio, which I share with the world every month, I actually, I track this myself just for my personal information in this column here, the annual dividend column of every split fund that I own. I actually say what the monthly distributions missed are since inception. So you see Dividend 15, 4 out of 216 dividends. FTN missed 34 out of 219. So you could download my file to see the ones that I own, the dividend history, very quickly, or you could do it yourself, or better yet, if you download and purchase the ultimate DIY investing package, my split fund section specifically tells you the dividend miss history on most of these. So those are the ways you could do it. So factor number 3, you got to know how many dividends has this fund missed, especially if it's been around a long time, because it gives you an indication on future dividend misses. So you're ready to, you understand and know the possibility of what could come in the future. Next factor to consider, everyone, and this factor is valid for everything, is portfolio composition or fund composition. You got to know what stocks are in a split fund. So you know what's actually inside the fund. It's the most important thing. When you're investing in a split fund or an ETF, many people just think they're investing in that ETF. That's not the case. You're actually investing in the stocks inside the fund. So very important to look at the fund's composition. And generally, the more diversified it is, the safer it is, the better off it is, and the less chance of missing dividends. But that's not always the case. So for perfect examples would be Brompton Split Bancorp, or BK on the QuadraVest side, right? Its competitor. So this only has the 6 banks, but whereas Life and Bank Split Corp has the 6 banks and the 4 life insurance companies, then you have Dividend Growth Split Fund, which has a lot more stocks, a lot more diversification all over Canada. It has a lot more sector diversification. But out of all 3 of these, DGS, the one that's the most diversified, misses the most dividends. And Brompton Split Corp, which only has the 6 banks, misses the least. But it's not only about the missed dividends as well. It's also about the annual compound returns, which is my next point, and I'll show you in a second. So before investing in any split fund, you have to understand what you're actually investing in. What are the holdings or the stocks inside the split fund? Because that's really what you're investing in. And typically, the more niche something is, if, for example, FFN or FTN, it's only financials, right? So the more niche something is, if it's just financials, all financials, and all financials crash, well, this fund is going to crash very, very hard, because all it has is financials, compared to DFN, which has a lot of financials, but it also has other stuff like Enbridge, TELUS, Bell, TC Energy, some pipelines. So it's a bit more diversified. So if financials crash, but energy doesn't, or energy is doing well, there's a bit of an offset. So typically, you're better off with a split fund that's more diversified. And this is why I always say the Global Dividend Growth Split Fund is my favorite split fund of all time, because it's the most diversified. It's not only diversified by sector. When people think diversification, they typically think only sector, but it's also region, right? So DFN, DGS, very well diversified in sector, but it's only Canada. Whereas GDV, it's diversified in region and sector. So typically, everyone, the more diversified you are, or the fund is, the better it is. So that's another fact. Another important factor, second last one, is what is the annual compound return on average for the split fund class A share. So this goes, you could check this for every single fund. So this is very important because typically with split funds, people tend to only look at the stock chart, and the stock charts do not look good on a lot of split funds because they're very aggressive with the income, and stock charts do not incorporate income in there. It only incorporates the stock price. So if you're just looking at stock price when it comes to split funds, you're completely wasting your time. That does not make any sense because most of the returns, especially the class A shares, comes from the income. Preferred shares as well, it's all from the income actually, because it always stays at $10, the stock price. But you have to consider the income, and an easy way to do that is look at the annual compound total return when you're looking at a split fund. So SBC, for example, any Brompton one, you could check it out by clicking on performance, and you will see the breakdown. Super cool, the annual compound return. So if you're looking, you got to always make sure you're looking at the class A share. So first of all, you'll see that typically the class A shares will always beat the preferred shares. So since inception, you're at 10.7%. In the last 10 years on average, if you hold SBC for the last 10 years on average, you're looking at a 14.9% return every year on average. So a lot of people are very surprised, myself included, when you look at the split fund class A shares annual compound returns, you will typically be pleasantly surprised. So SBC beats the overall Canadian market by far, and even the S&P 500. So that's how powerful the 6 banks are. So if you would hold SBC, even if your stock price would be lower, you got to incorporate the income, which the annual compound return does. This is returns, let's say if you're dripping it, right? So if you're dripping it, even if you're not dripping it, with that income you get, whatever you do with it, combined with the stock price. So this is stock price combined with the income, very important. Takes into account the total, the annual compound return. So you're making a really, really nice return in the last 10 years of 14.9 for SBC. If you're looking at LBS, which misses dividends, LBS missed maybe 15 to 20 dividends or something like that. If you look at the performance, it also has a really nice performance of over 9%. In the last 10 years, 18.8%, very, very, very strong. Look at DGS, which misses a lot of dividends and is missing dividends now. Even with that, the return is over 8% since inception, over 14% in the last 10 years. For the QuadraVest ones, there's no performance tab per se. You have to look in the annual information form. So this is DFN's 2021 annual information form, and as you can see, the class A share, stellar annual compound return since inception. Even though DFN stock price is on the downswing, I get this question all the time. It looks like my NAV is eroding from the split fund. Stop looking only at the stock price. You cannot do that with a split fund. It makes no sense. You have to incorporate the income. So if you incorporate the income, class A share of DFN, over 10% return since inception. In the last 10 years, 13.52 on average every year return. FTN. Let's look at DF now, Dividend 15.2, which is a more aggressive version of Dividend 15. Same stocks, but misses a lot more dividends. You're still looking at really nice returns since inception. FTN, which only has the financials, same thing. If you look, you have pretty good overall annual returns. FFN, which is now missing, has, since inception, it's a bit lower, but if you look at the last 5 years, 10 years, they all have really nice average returns on average annually. So very important to look at this, at the annual average compound returns, because this incorporates the income as well as the stock price automatically. So it's a very, very cool indicator to really know how the Class A shares perform, and you'll be probably pleasantly surprised. They typically beat the overall stock market. So these are very, very good investments. And keep in mind that performance, this is after fees, right? So fees are already taken off there. So you're really getting an accurate reading of how these funds are performing, how the Class A shares are performing. And as you can clearly see, typically they always beat the preferred shares But there are some circumstances where the Class A shares, they don't do well, like the life insurance ones, for example. If you look at the ones that are like LFE and LCS that are just the life insurance companies, the Class A shares typically don't do well, or they haven't done well. So portfolio, that goes back to my earlier point, portfolio composition, but also here's another factor, the annual compound return. So just looking at the stock price won't do it, makes no sense. That's what noobs and amateurs do, income investors do. You got to look at the income as well. Easy way to do that, you look at the annual compound returns. So last factor, and this is probably the most important one. And before I get into it, I just want to remind you that I recently did a 38 or 40-minute Q&A video with the Senior Vice President of Brompton for split funds. So I talked to Michelle, who manages, well, not manages because they have portfolio managers, but who is in charge of all the split funds and closed-end funds at Brompton. And we talk about split funds in detail. We talk about that $15 rule. We talk about how they always seem to go down in price over time. So a lot of the very common questions and concerns I get about split funds, we discuss. And this is a true professional split fund manager. So I strongly suggest, if you haven't seen it yet and you're thinking about investing in split funds, you already have split funds, watch that interview. I mean, this is a really, really good interview. You could get a lot of great answers to your questions there. And then, of course, another reminder, I have that 1 hour long split funds explained video if you're a bit newer and you want to really learn more about them, more the basics. So make sure to check out those two videos. Now, last factor, factor number 6, probably the most important fact is you have to consider your portfolio, your situation, and your risk tolerance of missing dividends. So very important, whenever I talk about risk when it comes to split funds, I am not talking about the risk of stock quality, because like you can see, if you look at the fund composition or the stocks inside split funds, they're usually very, very safe, boring, blue chip quality stocks. The reason why they have, so the risk is not pertaining to this company quality. It's not like we're investing in penny stocks or even mid cap stocks. These are big blue chip stocks. The risk assessment I'm really talking about is missing dividends. The reason is because typically income-oriented investors like myself, some of us live off our investments. So it could be very detrimental, or could be a big deal if we have a big amount of split funds and we start missing dividends, right? Because if we're missing 10, 15, 20% of our income every month, some people that are on a fixed budget cannot afford to. So it's very important to consider, if you cannot afford to miss dividends, I probably wouldn't suggest any split funds, or at least get the really low risk split funds. So this factor is all about your personal situation. You can't, I'm a big proponent in thinking that investments are not good or bad, black and white, which ones are the best, which ones are the worst. You can't look at it that way. It's which ones are the best for you and your situation. So you have to look at your portfolio composition. Always make sure you stay diversified. So you don't want to just load up on all the financial split funds and then your portfolio ends up being 45% financials, right? So your portfolio composition, you have to take into account your tolerance of potentially missing dividends. You have to take it into account. I would put myself in a moderate to maybe moderate to aggressive. I would say moderate. So I do have some split funds like DFN, like DGS, FTN, LBS, which are a little bit higher risk, not at the high range like FFN and Dividend 15-2, for example. But I also have the majority of my split funds in the lower risk split funds like RS, SBC, ENS, which, you know, RS and ENS have never missed a dividend. I think SBC only missed 4 back in 2008 during the recession. So combine all the factors we discuss and really focus on yourself, not what everyone else is buying and what everyone else is doing, but how tolerant can you be with the split funds. Don't forget what split funds are, Class A shares are. Think of it like a covered call ETF portfolio with leverage. That's really all it is. So you have to expect missing dividends, and it's not the end of the world if you miss a bit of dividends, right? So if you're on a fixed budget and you can't afford to miss any income whatsoever, it's a big deal. But if you have other sources of income and, you know, your DGS and FFN is not paying, and that's okay, it's not like you're going to be on the streets, right? Everyone has a different tolerance of missing dividends. So it's very important that you factor that in. And also volatility, because these are leveraged. Class A shares are leveraged, which means when the market goes down, they will go down very hard. typically. So you have to be prepared for volatility as well. So if you can't stomach the heat, if you can't stomach the volatility, the potential of missing dividends, I would say stick with only the safer ones and maybe don't even invest in them at all, because now we have the privilege of having amazing funds like the all-in-one covered call ETFs, HDIV, HYLD, HDIF from Harvest. Hopefully there's more that come out. We're privileged with these new products because they have the same exact attributes of split funds: good quality stocks, covered calls, and leverage without the risk of missing dividends, because they're not a split fund. They don't have that $15 unit NAV rule, right? And the yields are high. But split funds can be a really interesting way to get really, really high yields, high annual returns like we saw, which will typically beat the market, but you got to be able to stomach it. If you can't, don't invest in them. You have to make sure you invest and build your portfolio according to your needs, not everyone else's, and it depends on your tolerance. And the way I look at it is, or the way I usually explain it to people, do whatever makes you sleep well at night. If having split funds does not make you sleep well at night, trust me, it's not worth it. Get something else. There's plenty of other funds in there. So that's the last important factor. So I hope this split fund video was informative for you, and it helped you really decide going forward about split funds and things like that. So if you, give me a thumbs up if you like this video, if you like this type of comments. Tell me, what do you think about my 6 factors? Are there other factors you think you should consider as well that I maybe forgot about? Let me know in the comment section below. Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys, where I ask the audience, I ask you what topic you want me to cover next. So very important. Subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors. So it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me, where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there. Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other, and it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel, will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right, in order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So, as usual, I continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.